Long-term S&P 500 Index, SPX, chart analysis, navigating market turbulence. The S&P 500 Index, SPX, has been experiencing significant fluctuations recently, with notable declines and rebounds. In the next few minutes, we will delve into the recent market movements, technical indicators, and strategies for navigating the current market turbulence. Understanding the recent market movements. Last week's performance. The S&P 500 Index, SPX, experienced a notable decline, dropping by -2.06% for the week. Over the last 3 weeks, the index is down by -5.5%, signaling a period of increased volatility and market uncertainty. This week's market behavior. The week began with significant selling pressure, pushing the Volatility Index, VIX, to 65.67. However, a rebound occurred on Tuesday, indicating a mixed market sentiment and an uncertain future. Key technical indicators. 50-day moving average. The SPX has fallen below this critical line for the first time since April 2024. 200-day moving average. This line has acted as a support level, preventing further declines for now. Conservative S&P 500 strategy, long-term focus. The conservative S&P 500 strategy is engineered to shield investors from bear markets by weathering short-term declines without triggering sell signals. This approach is rooted in long-term chart analysis rather than reacting to immediate news events or market emotions. It's designed to accommodate market fluctuations without attempting to time every minor market movement. Current position. We maintain a bullish stance on the RIDEX S&P 500 Nova Fund, RYNVX, or similar S&P 500 index funds or ETFs like SPY. S&P 500 Index, SPX, and current chart analysis, market trends and fears. Last week's summary. The NASDAQ 100 Index, NDX, transitioned from a market leader to a correction phase, down by -11.1% in 3 weeks. In contrast, the S&P 500 Index, SPX, declined by -5.5%, with most of the loss occurring last week. This week's market dynamics. U.S. stock markets experienced a sell-off on Monday, driven by global recession fears. This intense selling generated extreme fear, as evidenced by the CBOE Volatility Index, VIX, which spiked to 65.73 before settling at 20.37 by week's end. Factors driving fear. Disappointing jobs report sparked fears of an impending U.S. recession. Federal Reserve's interest rate decisions, concerns that the Fed missed the opportunity for a soft landing by not cutting rates sooner, opting instead to maintain the highest rates in 2 decades. Market outlook. We anticipate that the extreme selling and subsequent buying have caused technical damage, potentially leading to further declines in the coming weeks. As trend followers, we will adjust our position based on market trends. If an uptrend resumes, we will adopt a bullish stance, otherwise, we will remain in cash for safety. Key support level. Watch the SPX level at 5180. A drop below this support could signal continued declines. Recession risk analysis. Yield curve inversion. A yield curve inversion occurred 20 months ago, often a precursor to recessions. While a technical recession may not be confirmed, the sentiment among the American working and middle class suggests a recessionary feeling, influenced by rising costs and economic pressures. Economic sentiment. Former CKE Restaurants CEO Andy Puzder highlighted, consumer perception, 78% of Americans view fast food as a luxury. Parental sacrifices, 50% of parents may forego essentials to afford school supplies. Market-moving economic reports. ISM Services PMI. The ISM Services PMI rose to 51.4 in July 2024 from 48.8, indicating a moderate rebound in U.S. services activity. Redbook Index. The Redbook Index increased by 5.1% in the week ending August 3, 2024, compared to the same week in the previous year. Mortgage rates. The average contract interest rate for 30-year fixed-rate mortgages dropped to 6.55%, the lowest since May 2023. Unemployment claims. The number of unemployment benefit claims fell by 17K to 233K, the lowest in 4 weeks, and continuing claims rose to 1875K, the highest since November 2021. Conclusion. Given the current market conditions, our SPX position within this strategy is bearish. Aggressive traders are advised to stay in cash, money market funds, to mitigate risk during this period of heightened volatility.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.